A very good morning and thank you so much for your time. First of all, Siddharth, there's a lots that going in the markets for the past couple of days. Indian markets are under pressure, but it's not the same scenario when we talk about the global setup. But a lot of global news as well to watch out for. So, can you elaborate on the specific changes that you are witnessing in terms of the asset allocation, how this is making transition, and the rationale behind the same?
Sure. So, firstly, the way we're looking at markets, I mean, since 4 months now, we've been very, very defensive. So, when I say defensive, I mean our sectoral exposures have turned defensive. We are out of some of the higher beta cyclical sectors, such as, say, industrials, defense, real estate, power, or infrastructure for that matter. And we've transitioned completely to uh, FMCG, consumer staples, consumer durables, healthcare, within the auto pack, two wheelers, and within the financial pack, AMCs and insurance. So this has been the broad change in the sectors that we used to own earlier versus the sectors we've been owning for the last 4 months. When I talk about the style orientation of the fund, we've gone from a value momentum style orientation to a quality and low volatility style orientation for the past 4 months. And we've significantly reduced the portfolio beta as well. So I think a lot of conflicting and interesting things from a market perspective. Our view is clear that we believe that we are in a slightly risk transition zone with markets likely to consolidate with a bearish bias. So it's not like we think the bull run is over, but I think in the short term there is a slight bearish bias given that Indian markets are very, very richly valued. Whether you look at our valuations compared to the history of Indian markets, or whether you look at our valuations compared to the global peers as well. And now, specifically, with the slew of economic policy boosts that China has got, I think China has got a trigger, like an upside trigger, to play out in the near term. And given that the valuation differential between the Indian and Chinese markets was almost 70%, so like China was 7, 8p, India was 24, 25p. So I think Chinese markets were deeply undervalued as compared to the Indian markets. So I think this could attract some foreign flows towards China away from India within the emerging markets pack. So this is likely to be a risk factor. Uh, and when I look at my multi-asset fund, we've been very, very, constructive on gold for the last 8 months, and now even more so because given the rate cuts, the geopolitical stress, all the central bank buying action, and the traditional nature of gold as a hedge versus equity risk, geopolitical risk, recessionary risk, and potential supply chain, inflation. I think gold is quite the preferred asset class in a multi-asset setup, though we have no exposure to it in our equity, long only equity portfolios. So I think with all the global factors that we're looking at, whether it's the escalating war in the Middle East, or the rich valuations, or how China is making a comeback, I think India could be in a consolidative setup for some time to come.
India could be in a consolidative setup to make a comeback, but Siddharth, does that mean that are we in for some more correction in the near term? Because I believe that for the mid and the long term, the stand still remains positive.
Absolutely. So, I mean, medium to long term, the structural story of India is top notch. I don't think we have anything to worry about there. In fact, if you look at the volatility indexes as well, whether I look at VIX, which is the headline index, or some of our proprietary volatility indicators, everything suggests that over the last 30, 40 days, volatility has sort of bottomed out in India, which means two things. One, that it's good for Indian markets. That's one way to look at it. But if I look at it from a mean reverting standpoint, it means that it's trading at multi-year lows and it can only rise from here. And if volatility is to rise, of course, we could see some minor correction or blip in the overall bull market that is being seen in India. Even honestly, if you look at the cash holdings data for mutual funds, I think we're at 5-year highs in terms of cash holdings. and that's simply due to valuations. So I think Indian markets are seeing high valuations, like slightly excessive valuation, and a lot of risk around global factors. The only positive in this broader setup is the US rate cut, which I think could push some foreign flows back to India, like we've seen in the last 3 to 6 months, that foreign flows have made a strong comeback. But I think the China angle can disrupt the smoothness of this flow to India for some time.
All right, the China angle could be a little disruptive for the Indian markets. But Siddharth, before I let you go, while I was taking a look at some of your top holdings, key to note is that there are indeed a couple of defensive names from the healthcare space. But apart from that, it's the consumption basket that you have tried to acquire in terms of some jewelry stocks, some of the auto majors. So Siddharth, this particular theme is what is garnering more of investors' interest right now. So good to believe that this is one of those defensive bets that still holds strong. And from here on, what sort of a return expectation that you have?
So ideally, the fund that I run, it's called Aqua. It's a pure alpha focused fund. And when we take defensive bets such as this, so broadly, my portfolio has 33% allocation to healthcare, another 33%, 35% allocation to consumer staples and discretionary, 20% to two-wheelers and auto OEMs, and another 10-15% to financials, mainly AMCs and insurance. So when we take this defensive approach, we're looking at a couple of things to make sure these stocks do well for us. First, within all these sectors, we want some of the higher quality names to come in. Secondly, names which also have some sort of growth visibility in the near to medium term. And finally, from a price perspective, we need these names to have been exhibiting lower volatility than the rest of their industry peers, at the same time having some price momentum. So combination of quality, growth visibility, price momentum, much lower volatility, and some sort of valuation comfort is what we are looking at before we get these names in the portfolio. And again, the outcome or the agenda for owning these names is simply outperform the market. And in this scenario, outperformance would be when the markets fall, say 4-5%, and if we could curtail the fall to 1-2% or generate 1-2% absolute positive returns in the near to medium term, I think that's a good outcome as well in a consolidated or a bearish setup.
All right, understand with Siddharth. With this, we'll let you go on that. Thank you so much for taking the time out and joining us, as well as also helping us understand that how are you making the changes to your current portfolio and what is the outlook going ahead as for you. Pleasure having you.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.